The broadcast is now starting. All attendees are in listen-only mode.
Hello, ladies and gentlemen. Thank you for standing by and taking the time to join us for today's webcast, PPP Loan Forgiveness. During the presentation, all participants will be in a listen-only mode. Please use the question feature to submit your questions, which will be addressed at the end of the presentation. Without further delay, Dan, can you get us started?
Yeah, thank you, Sarah. Welcome and thank you for joining us today. Again, I'm Dan Bogart, a Senior Vice President and Commercial Banking Division Director at Banner Bank. Most, if not all of you, are clients of Banner Bank, and I want to take a moment to say thank you for your business. Hosting events like this is an important part of earning your business, and we're grateful to partner with CliftonLarsonAllen for this program today. We consider them to be experts on this ever-evolving topic. As you all know, the SBA rolled out the PPP loan program quickly, and there have been some bumps, including frequent rules and guideline changes. Due to the overwhelming number of applications we received at Banner, we cross-trained more than 170 bank employees to assist our clients as quickly as possible, taking our regular SBA department of only 13 people to nearly 200 during this time. Many of these employees literally worked around the clock in shifts to maximize the number of loans we could process and fund. We have approved more than 8,500 applications and funded more than $1.1 billion in PPP loans. Now that we are in the forgiveness phase, we are seeing more challenges as the SBA shifts guidelines and revises what is required for forgiveness applications. As you know from an email you received from us recently, Banner Bank is developing an online platform to make it easier for you to complete and submit your forgiveness applications. It will interface with the SBA's original application and the recently announced Easy Form. We anticipate our version will have a calculator built in, again to help make it easier for you. We're busy incorporating the recent rule changes and the SBA's updated application changes, so our application system is not ready to roll out yet. You will receive an email from us as soon as it is available, and that will come with specific instructions. With you all preparing to complete your forgiveness applications, it's very timely for us to connect with the professionals at CliftonLarsonAllen for today's webinar. And now I'd like to introduce today's presenters. First, Jack Rybicki. He is a managing principal in CLA's Tampa, Florida office. Jack earned an accounting degree from the University of Florida and has more than 27 years of experience performing audit and consulting services for a variety of clients in the financial services industry. Also presenting is Paul Bailey. Paul is a managing principal in the Seattle area office for CLA in Bellevue. Paul earned his accounting degree from Central Washington University and has more than 24 years of experience performing audit and consulting services for a variety of clients in the private equity industry. Thank you both for being here, and the floor is yours.
Thanks, Dan. Appreciate the opportunity to be here with you. Hearing the numbers of what you accomplished in such a short period is pretty impressive, and we're grateful to be able to be part of this and work alongside Banner Bank and providing a little bit of information to your clients. As you mentioned, Jack is in our Tampa office. He's really been leading our COVID response team, and so grateful for him to be here. He's going to be the primary individual in the presentation, and I'll turn it to you, Jack, for kicking this off.
Great, thanks, Paul, and Dan. Thank you so much for having us and inviting us in to do this presentation. So, as Dan mentioned, CLA is a professional services firm, and we are not the law firm. And so I do. Our attorneys have said I have to go through a quick disclaimer on this, that this is a very shifting landscape. We have tried to update this presentation for you as much as we can, and so there was guidance that came out on Monday that was fairly significant that has been incorporated into this presentation. But there are a lot of interpretive matters here, and so we're trying to do our best to interpret this We will get more guidance out, and the landscape will continue to change here. So all I ask is that when you do go to file your loan forgiveness application, make sure that you are consulting with your CPA and your attorney to make sure that you've got the latest and greatest interpretations that are out there. So we're going to start really kind of going over some more recent developments that have shifted the landscape, and we'll kind of go back to the basics at the end of the presentation. So if you have questions about the types of includable costs, things of that nature, we will get to those towards the back end, and we'll even go through how the forgiveness calculations themselves work. But we're going to start with what's really been going on in the landscape recently, because it has changed the way forgiveness will work fairly dramatically. And so we wanted to make sure that we brought everybody up to speed with those new developments. So, the most recent development that really kind of put everything on its ear is the PPP Flexibility Act. And so, this was passed by the House in May, the last week of May, and then was taken up by the Senate and passed the Senate on the 3rd and ultimately signed into law by the President on the 5th of June. And since then, the Treasury and the SBA, as the administrators of this program, have now been going back through, and a flurry of activity has happened in relatively a short order. So less than 3 weeks, a number of new interim final rules, which is the way they administer the program, have come out to amend a lot of the prior guidance that had been issued that was now superseded by the PPP Flexibility Act, as well as new applications, both for loans, loan applications to apply for PPP loans, because the funds still are available, as well as the PPP loan forgiveness application. And we actually got a new application as well, an EZ form that we're going to talk about today. So we're going to cover the main things that were part of the Flexibility Act, as well as the enhancements that came through the interim final rules that recently were adopted. The biggest thing that was part of the Flexibility Act was that it changed the covered period. So when many of you received your loans back in April and May, and maybe even in early June, you thought you would have an 8-week period to use those loan proceeds. What was happening, though, is a lot of companies were not able to return to normal business operations, and as a result, they were having trouble using all of their loan proceeds. Fortunately, Congress heard those cries that were out there from the business community, saw the recovery time period wasn't as quick as they thought there was going to be, and extended the covered period to 24 weeks. And so now you've got, you can use, if you were granted a loan before June 5th, you can use your original 8-week period if you'd like, or you can use this new extended 24-week period. And any loans originated after June 5th all have a 24-week covered period. Now, the good thing is you don't have to wait till the end of that 24 weeks, though, to apply for forgiveness. So if you need more than 8 weeks, but you don't need 24, you can apply for forgiveness before then. And the IFR that came out earlier this week on June 22nd went into that. And so we'll cover that in a bit more detail shortly. Terms for new loans were also changed, and so while the existing loans had a 2-year maturity date on those, and the maturity date of those previous loans did not change, any new loans that were granted after June 5th all have a maturity date of 5 years. And so while you can potentially extend the maturity date on your loan by reaching out to Dan and the bank, we expect that because the time period is now a little bit more gracious and the rules around forgiveness have been laxed a bit, that hopefully most of you are going to get, at or near 100% forgiveness, and the 2-year maturity for those original loans shouldn't be a problem. Now, we also got some rules in the Flexibility Act around the timing of when you need to request forgiveness. So there was really no time frame in the original CARES Act. However, when it was implemented by the SBA, they set up a 6-month deferral period, basically saying that you didn't have to pay interest or principal for 6 months, but then after that point in time, you would have to start paying off the loan. So that really kind of established a time period that most people were going to try to request forgiveness in pretty quickly after the covered period ended. However, now that you've got a 24-week covered period, that 24 weeks would butt up potentially against the 6-month time period. And so what Congress did is they actually changed the rules, and this is retroactive back to all loans. And they've said that you do not have to start paying off your loan until the SBA has purchased the loan that's going to be forgiven from your bank. So in that case, the bank knows what portion is going to be left out there that you'll have to pay off. Now, if you don't request forgiveness within 10 months of the end of your covered period, though, then you have to start paying the loan back. And so if you think about the revised timings, you now have 24 weeks to potentially use the money. So let's say, roughly 5.5 to 6 months. And then you have another 10 months after that, during that time, where you can choose to request forgiveness. And so that gets you out to 16 months now after your loan origination date. And as Dan will tell you, it's going to take the bank, probably 30 to 60 days to process the loans, their loan forgiveness application. And so you've got, the banks have 60 days, although the SBA has said they might give some grace on that. And then the SBA has another 90 days to look at the loan forgiveness application. So between the bank and the SBA, potentially yet another 5 months of time. So this whole process, you can see, is getting stretched out such that you might not know about forgiveness for maybe as much as 20 months after your loan is originated. So that could be problematic if you don't get forgiveness, because with the original loan term of 2 years, that would only give you 4 months to service the outstanding balance. But as you'll hear from the rest of the presentation, with the new terms that are out there and the new safe harbors that are also being put in place, it's expected that a significant portion of the loan proceeds are now going to be forgiven. The other thing that changed, dramatically in the Flexibility Act was what was being referred to as the 75% test, right? So of the amount that you requested forgiveness for, 75% of that had to be spent on payroll, and therefore only 25% could be spent on non-payroll related items. Again, there was a lot of concerns that because we weren't able to hire employees back, but those holding costs like rent and utilities and interest on mortgages still were accumulating, that whole 75-25 split really wasn't the right split. And so as a result of that, Congress did step in again, and they lowered that threshold down to 60% for payroll and no more than 40% for non-payroll items. Again, making it a little bit easier to get forgiveness for companies once they are up and running. We will talk a little bit about how this was originally interpreted as well, because there was some concerns about the way it was written and the fact that it might have been, if you didn't get to 60%, you might not get any forgiveness. We did get the good news on that. And what I think is probably the best news that was out there is this new safe harbor for the FTE reduction test. This has gotten some press, but probably not as much as it needs to. And ultimately, I think this will be the thing that drives a lot of forgiveness that companies would not have otherwise gotten. And basically, it provides that if you are not able to conduct business at normal levels during your covered period, and you can show that that gets related back to guidance or regulations that were ultimately promulgated by one of 3 federal agencies, the Health and Human Services, OSHA, or the CDC, that If your decline in FTEs as a result of that, then you no longer need to apply the FTE reduction test for forgiveness. Now, this is huge because people were trying to manage FTEs, trying to figure out how to maximize the FTEs during that 8-week period. In some cases, people had even brought people back. Borrowers had brought payroll back so they could get to 100% forgiveness. With this now new flexibility here, take for instance a restaurant that was unable to open during the part of the covered period, and then maybe on the back part of the covered period is only operating at 25 or 50% capacity. An organization like that no longer has to worry about having a reduction because their FTE count was less than 100%. And they don't have to worry about meeting one of the safe harbors where they would eliminate any reductions that they had. Because this new safe harbor is there, you can eliminate the need to do the FTE reduction test. So that's going to be very powerful for people as they go through and look for forgiveness. Two other things that I want to highlight, and then we'll go into the IFRs themselves. Many of you may have been aware that there is a payroll tax deferral program out there. However, if you participated in the PPP program, the way the CARES Act was originally envisioned, it said that you were not able to defer payment of the payroll taxes if you participated in the PPP. However, and that makes sense, right? So, because you're not going to have to pay effectively the payroll taxes on the employee side because you're going to get compensated for those through the PPP forgiveness. And so as a result of that, they didn't want you to kind of double dip, both borrow the money and then not have to pay it to begin with. However, because the employer federal payroll taxes are not eligible for forgiveness, you can now participate in the payroll tax deferral program related to employer portion of taxes. So what that program is, it allows you to basically retain the employer portion of payroll taxes from March 27th through the end of this year, and then you would pay that amount back 50% at the end of 2021, and then the other 50% at the end of 2022. So basically you get a 2-year interest-free loan for your payroll taxes, the employer portion of those payroll taxes. So definitely a great working capital opportunity, really no cost to it. And we have that first quarterly payroll tax filing coming up, with the June 30th quarter. So if you did remit taxes up to this point, that would be your opportunity to get a refund of those payroll taxes previously remitted for the employer portion of those, and then you won't have to remit those in the future through the end of this year if you want to take advantage of this program. So that was another great bit of relief, and again, providing some liquidity to borrowers that were out there. Now, the one thing that we didn't get in the Flexibility Act, though, was many of you have, I'm sure, undoubtedly heard that the forgiveness that you get under this program is not taxable. However, the IRS did come out and said that since the forgiveness isn't taxable, the costs that you pay with the forgiven funds are also not going to be deductible. Now, that's, effectively a net zero on your tax return, so that's not a bad thing. However, many people were expecting to get those deductions. And so as a result of that, it could increase your profitability. Let's say if you had revenues at like a 50%, now you might not have any costs against those for some period of time. Actually increases your tax liability as a result of that. Now, the good thing is we have many senators that are out there, on record right now saying that that was not legislative intent, that their intention was that those expenses would be deductible. And so we do expect that sometime this year in a future round of legislation that we will get the Congress to reverse that decision that was made by the IRS and overrule it effectively and allow those expenses to be deductible. We hope that that's the case, and there's a lot of positive support for that, but we don't know if that's going to happen for sure. The Flexibility Act was one of those that could have taken care of it, but unfortunately they did not take care of it there. So now we're going to go into the loan forgiveness applications. So 2 new loan forgiveness applications were issued as a result of the PPP Flexibility Act. The first one was just an amendment to the initial loan forgiveness application that was previously out there for the 8-week period. And so for that one, the application was just modified a bit, and as a result of that, you know, it allowed for the 24-week period and other things like that. And so that part was, you know, very positive. Dan, could I get you to mute your mic? I think we're getting just a little bit of background noise from you. I'm sorry there. Thank you very much. That's perfect. The other form that was issued, though, is going to make life a lot easier for folks. And so there was a new form 3508, which is an EZ form. And basically, if you meet one of 3 criteria now, you are eligible to file on this EZ form. And the EZ form basically has no reductions on it. It basically looks at the amounts you spent. As long as those amounts that you spent are above the loan amount and 60% of those amounts are spent on payroll, you get your loan forgiven. Now, you have to qualify to use the EZ form, right? And so there are 3 different groups of borrowers that are going to be able to use the EZ form. However, we think that this should be allowable for a lot of borrowers that are out there. So first of all, on the lower end or the small end of the scale, if you're self-employed and have no employees, so this would be like a Schedule C or a Schedule F self-employed individual, and you had, again, no employees, you can use the EZ form. Basically, you'll choose the 24-week period. You'll be able to get 100% of your loan forgiven now with a very easy, simple to file form. Now, for larger businesses that do have employees, there are 2 other categories that are out there that you could potentially meet to be able to take advantage of the EZ form. So the first would be that if you meet the safe harbors related to wage reductions and headcount reductions. So if you had no wage reductions in excess of 25% during the covered period, and you didn't have any headcount reductions during that period of time, you would meet the safe harbor, right? Again, you know, that one might be difficult for some groups to meet because in a lot of cases, because your business was impacted, you likely did have headcount reductions, even though you might not have reduced the actual wages that you paid to people. However, the second of the 2 business-related safe harbors gets back into that new safe harbor that I was talking about. And so again, the third opportunity to use the Form EZ is if you had no reduction in wages greater than 25%, and if you were unable to operate at your prior level of business activities, and you can document that during at any point during the covered period. Now, we think that that's going to sweep up a significant group of borrowers out there. Basically, anybody that was impacted negatively by stay-at-home orders or closures or anything like that will eventually be able to take advantage of this, that you were unable to operate at the prior level of business activity safe harbor. And so as a result of that, assuming you didn't reduce the actual wages by more than 25%, you would be able to meet this safe harbor because you would have no wage reduction test and no FTE test reduction test, and as a result of that, you'd be able to take this this easy form. Now, it's not quite so easy. You do have to have all the supporting documentation that supports that you didn't have wage reductions and you weren't able to operate. But the good part is you don't have to submit all of that documentation to the SBA, and you just have to aggregate it all. So this is a great opportunity for both the banks to minimize the level of effort that they're going to need to put forth on reviewing these applications, and then obviously for the borrowers themselves that are submitting for forgiveness. So there were a couple other things that came out on the applications that were worthwhile talking about. There was a lot of questions about how caps on wages are going to work, and we're going to go into that in one of the subsequent IFRs. There were also some clarifications on health insurance and retirement plan costs for owners, and we actually got even better clarification on the IFR that came out earlier this week that we'll go into. And then I mentioned the safe harbors already that were there. These safe harbors are actually much better than we thought they originally were. There was a concern when the covered period got moved back to December 31st from June 30th as the end of the program, that ultimately you'd have to satisfy all the safe harbors by keeping your people on staff through December 31st. The good part is the application clarified that in order to meet those safe harbors, you really only have to meet them as of or before the date you file for loan forgiveness. And since we got some flexibility on the timing of when you have to file for loan forgiveness, and that can be done earlier now, it really is a good set of safe harbors out there that are very friendly to the borrowers now. So we're going to go into the new IFR that was issued this week now, because it really hit on 2 or 3 critical areas that I want to go over, and then we'll get into more of the details on loan forgiveness and how that works. So the first piece I mentioned was the Flexibility Act extended it to either an 8-week period or a 24-week period. And there was concern that you would have to wait till the end of the 24 weeks to file for forgiveness. So the new IFR clearly states that you can file for forgiveness as soon as you've spent all the loan proceeds that you're going to ask for forgiveness for. And so that doesn't say you have to file when that happens. It just says you can file at that point. And so that's a positive thing in that you could file. So if you just need an extra 2 weeks to get to full utilization of your loan proceeds, you could file after 10 weeks now for loan forgiveness. We also got a little guidance on what that means. So in the event that you're going to file using a time period somewhere between 8 and 24 weeks, the one thing that came out that was a little bit negative is that if you do have a wage reduction, then you do have to apply that wage reduction as if you were using the full 24-week period. And so, for instance, I'll give an example. Even though you might be applying for loan forgiveness, let's say after 10 weeks, if you happen to reduce somebody's salary from $200 a week down to $125 a week, right? You're allowed to reduce that person's compensation by 25%, which would have taken it down to $150 per week. Since you reduced it by $25 more than that, you'll have to have a wage reduction in the forgiveness. And normally that gets calculated by that $25 per week amount times the number of weeks that were in your forgiveness period. So for an 8-week period, that would only be a $200 reduction. Now, one would think that if you were filing for forgiveness after 10 weeks, you would just take your 10 weeks times that same $25 deduction and come up with a $250 reduction. However, the way this works is you actually take that $25 reduction and multiply it times 24. What that's telling us is that while you can ask for forgiveness before the end of the 24 weeks, the 24 weeks is still your covered period, and you'll get penalized for wage reductions as if you were still outstanding for that full 24 weeks. So in my example, that would end up costing you $600 for that employee related to your forgiveness. Now, that was the only guidance we got, though, on this, which tells me that, the expectation is that the FTE reduction test is not going to be a significant issue for people going forward because of the new safe harbors. And so, we have no idea, though, how this is going to be reflected on the applications, and we do expect a lot more guidance to come out on how this flexible timing works moving forward. The new IFR also addressed the owner-employee issue and added a lot of clarity related to that. And so I'll go over those very briefly because I know we have a lot of folks that have owner-employees that are part of their loan forgiveness process. So if you're a C Corp, basically a C Corp owner employee is treated virtually the same as a normal employee. You can include the employer health care and employer retirement contributions on that owner employee's behalf. The only thing that's different is that if you choose to use a longer period of time, let's say 24 weeks, for an owner employee of a C corporation, you are limited to 2.5 months of their compensation. And for all owner employees, you're always going to base that on 2019 payroll data. Whereas your regular employees, you're going to base it on actual amounts paid during the covered period. Now, the reason they do this is they don't want owner employees to manipulate their payroll by giving themselves raises to get themselves up to, let's say, that $100,000 mark, so more of the loan forgiveness could go to them. So that's why they made it that owner employees are based on 2019 compensation levels. Now for S Corps, it's a little different. So I mentioned C Corps, you can include healthcare and retirement contributions. Unfortunately, for S corporations, you are not allowed to include employer-paid healthcare benefits for S corporation owners. The only thing that you can include is the employer-paid retirement contributions, but even those are limited back to that 2019 reference. For S Corp owner employees, you have to base your contribution on 2019 contributions to retirement plans for those owners. And again, it's subject to either 8 weeks worth of that if you're using a 8-week covered period, or if you're using the longer 24-week covered period, you can only use 2.5 months worth of the employer paid retirement contribution. Now, if you're in a partnership setting, or if you're a Schedule C or Schedule F filer, unfortunately, you cannot include anything beyond just your compensation. So there is no ability to include your healthcare or retirement contributions that are paid by your legal entity. You only get to deduct or have eligible for forgiveness your compensation for that was based on your 2019 levels. So that really did provide some great clarity there. I know we get a lot of questions on that, and hopefully with this new IFR, at least that part is fairly straightforward now. And I've already talked about the business activity safe harbor and how great we think it is. The new IFR actually expanded this even a little bit more, because initially the safe harbor had to have a direct correlation between the regulations or guidelines set forth by HHS, CDC, or OSHA. And so there was going to be a lot of difficulty connecting the dots between those guidelines that were out there from those federal agencies and what happened, in your local marketplace. And so now the new safe harbor actually expands that and says that if you can document that the reduction in business activity was either directly or indirectly related to COVID requirements or guidelines set by those entities, that you can meet the safe harbor. And specifically mentioned now is that most state and local governments shutdown orders and other things like that, because they were based on federal agency guidelines, now you can point to your state and local orders as a reason for meeting the safe harbor test. So again, making this as easy to apply as possible. Now you will need to provide documentation related to this though. So, go out to your whether it's your city, your county, or your state websites, grab copies of those executive orders that restricted your business activity and put those in your file, because you will need to provide that if requested to document why you took advantage of this safe harbor. Now, the only other thing I'll throw out there is that if requested, you may be required to provide some financial records to also support the fact that you are not able to operate kind of at normal business activity levels. So if you think about the ways that you would be able to do this, it would be through payroll records, which would show you had lower employee headcount during that period of time. financial statements, sales tax forms, things like that that showed that your revenue declined during those periods of time. So you will have to pull those records together to support this assertion. Now, the good thing is you may not have to produce those, only if requested by the SBA, but you do need to make sure you've got the documentation together to support this safe harbor if you are going to use the EZ form. Now, you can use the same safe harbor if you're going to use the long form, if you can't meet one of the wage reduction safe harbors. And in that case, you will be required to present this information to the bank for verification that you meet this FTE reduction test safe harbor. So just something to note there, that while it's a great test, you know, if you're not using the EZ form, you may have to disclose some financial information that you otherwise didn't know you were going to have to disclose. So I'm going to jump down to a couple of the other IFRs that came out that clarified things a bit. The June 10th IFR dealt with the 60% payroll, 40% non-payroll requirement. And I mentioned earlier, the way that was written in the original PPP Flexibility Act, there was a concern that if you did not get to 60% or use 60% of your loan proceeds on payroll, that you would not be eligible for any forgiveness. This IFR that came out clarified that that was not the intention, and that you'll be able to apply this whole 60-40 test very similar to the way the 75-25 payroll, non-payroll test was going to be applied before. Basically, that it's a proportionate reduction in your payroll or in your forgiveness amount. And I can give a quick example. Let's say you had a $100,000 loan, but even over the 24-week period, for whatever reason, you were only able to utilize, let's say, $50,000 or 50% of your loan for payroll. What you would do is, to determine the amount that you would get forgiveness for, you would take that $50,000, divide it by 0.6, and that would give you your new maximum forgiveness amount. It would be something less than your full loan amount, but it would not eliminate forgiveness altogether. So that proportional limit on payroll and non-payroll is very beneficial for borrowers. One other thing that I wanted to note, and now we're going back to IFRs that were issued, you know, back in May. We used to get a lot of questions around payroll costs and are bonuses and things like hazard pay allowable? Can you use those? And we did get this IFR that came out that clarified that bonuses and hazard pay are includable as part of your payroll costs that are eligible for forgiveness. So that was great news. That helped out quite a bit. So, you know, we've got about 20 minutes left, and I know that I've got some folks that are answering questions in the chat, but I do want to make sure I cover a few of those, and I'm going to do that in the context of the basics on loan forgiveness. And so we're going to start with the basic costs that are part of and eligible for forgiveness. And so there's really two buckets of costs. The first of those is payroll costs. And payroll costs have four main components to them. Salaries and wages, which include things like PTO and sick pay, separation payments. We've had a question about tips, and I'll specifically address that shortly. But payroll costs, and those salaries and wages are what we would call the cash component of payroll. And then there's the non-cash components of payroll, which relate to group health benefits, retirement plan contributions, and then the employer portion of any state and local payroll taxes. You recall from our earlier conversation, the employer portion of federal taxes are not subject to forgiveness, but the employer portion of state and local payroll taxes are eligible for the forgiveness calculation. So related to payroll costs, a few things are helpful to know. So you can use either your your covered period, which is the 8-week or 24-week period that starts the date you get your loan, or if you have a weekly or biweekly payroll cycle, so something that could correspond to either an 8 or 24-week period, you can use an alternative payroll covered period. So basically you could start your 8-week period or your 24-week period the first day of the first payroll period that started after your loan disbursement. And the reason that they're allowing you to do this is so that way you can match up payroll periods with the with your covered period, so it makes it administratively a little bit easier. Now, the reason they didn't make this available for, like, let's say bi-monthly or monthly payroll groups is that you're never going to be able to match that time period up to either an 8 or 24-week period. And so as a result of that, you're going to have the administrative burden anyway. And so for groups that pay on those basis, you just have to use your covered period. Now, we did get some flexibility on what is going to be includable in payroll. And so, you know, one main thing that we always got asked was, you know, is it, you know, what I paid during the 8-week period, or what about, or is it incurred during the 8-week period? Does it have to be both paid and incurred? Is it going to be that I have less than 8 weeks? That could be included in there. The guidance that we see out there right now actually makes it look like you're going to be able to get somewhere between 9 and 10 weeks of payroll included if you're trying to use your 8-week payroll original covered period, for instance. And the reason is that the way the wording works is it says that if a payroll is paid during your covered period, it's includable and eligible for forgiveness. However, if a payroll is incurred during your covered period and then paid in the next normal payroll cycle, you can also include that payroll. And so that really takes care of the back end and the front end and potentially gives you the ability to include all payroll through the end of your covered period, plus a little bit on the front end that might have actually been incurred before your loan originated, but got paid after your loan got originated. And so we thought that was a very helpful, you know, interpretation, and it would potentially allow people to meet the 8-week covered period and utilize all of the funds during that period of time. Now, we've talked a little bit about the 100% or the $100,000 limitation that's out there, and I do want to go through that in a little more detail. So, eligibility for forgiveness is limited to a $100,000 annualized maximum amount for an employee, and the same thing goes for an owner, right? So if you made more than $100,000 in 2019. During the 8-week period, both employees and owners are limited to 8 weeks worth of compensation. And so 8 weeks divided by 52 weeks is roughly 15.4%. That multiplied times $100,000 gives you that $15,385 limit that you can request for forgiveness for any one employee during the covered period. Now, that's not to say you can't pay employees more than that, only that that's the piece that would be eligible for forgiveness. Now we got to a question that, well, what if I use the 24-week period? Does that number get multiplied by 3, or how does that work? And the answer is yes. For employees, it just gets multiplied by 3. Now your covered period is 24 weeks, and so now the amount that is eligible for forgiveness for any one employee paid during that period of time goes up to $46,154. Now, I already mentioned, though, owners did not get the same treatment here. And the reason why is they didn't want owners to be abusive. They didn't want owners to fire employees and take a bigger benefit for themselves. And so what they said for owners was, since the most you could have gotten related to owner compensation was 2.5 months of your prior year amount, or $20,833, that's the most we're going to allow you to get forgiveness for related to owner compensation. And so Again, that makes sense in the context of keeping people employed and not wanting to, let owners take advantage of the situation that was created using the 24-week period. But this did, open up a lot of things, because if you thought about what was going to happen for Schedule C folks that have no employees, unfortunately, using the 8-week period, they were only going to be eligible for $15,000 of forgiveness, but they may have gotten a $20,000 loan. And so there was going to be a portion of that loan that would have had to be paid back if you were a Schedule C filer. Now, because you can stretch that out to 24-week period, you can now expect to get full forgiveness of those loans for those Schedule C filers with no employees. So some great guidance that was out there, and again, making life easier, because now for those folks you can even use the easy form. So the non-payroll costs, you do have to pay those during the period. We've already been through the healthcare costs and retirement contributions for owners, but I do want to stress that these costs, so your healthcare benefits that you pay, your retirement plan contributions, those have to be paid during that either 8 or 24-week period in order to be includable here. So just be very cognizant of the timing of those payments to make sure that you pay them during the appropriate windows. And the only other thing I'll note is that the piece of these things that you get to deduct and that ultimately is eligible for forgiveness is only the piece that the employer has to bear. And so for what I mean by that is, let's take, if you have a health insurance premium that's $1,000 for an employee, but you charge that employee $300 for that health care. And so as a result of that, your net cost as an employer is $700 for that employee. When you list the healthcare premiums on your loan forgiveness application, you would not list the $1,000 that you paid. You would only list the $700, which was the employer's net cost related to healthcare. The same thing goes for retirement plan contributions. You don't get to deduct amounts that the employee is contributing to their own retirement plan, only the incremental employer match or employer contribution. So we're going to go next to the non-payroll bucket, right? So now if you think about it, this non-payroll bucket is now limited to no more than 40% of your forgiveness amount, but it includes things like interest on mortgages, rent, and utilities. We get a lot of questions on these, so I'm going to cover a few of these, on the Q&A now. I do want to go back, though. I forgot to cover the tips component on the wages, and I know that that's a big issue for a lot of folks. Unfortunately, we don't have all the guidance we'd like on this, but what we do know is that when you're looking at the the January 1st through March 31st pay period to determine what your average pay rate was for an employee, you use gross wages. And we also know that for tipped employees, tips that are reported are included in the gross wage amount. So we know that, let's say somebody that might make a base wage of $7.50, but with tips, they might make $20, for instance. The $20 would be the wage that would be the comparable wage that you would be working off of for a tipped employee. Now what happens is when they come back, because volumes might be down, their reported tips might be off dramatically. And so even though you might still pay them that base $7.50 wage, with tips, they might only be making, let's say, $10 an hour now because their tips are down so much. In that case, you would have a wage rate reduction because the decrease in the tipped gross wages would be more than 25%. So there are a couple ways to deal with this in that context. One way would be to offer a stipend or provide a stipend to get that employee's wages up to 75% of the pre-COVID wage rate. So in that case that I gave where old wages were $20, if they were only effectively making $10 during the covered period, you could offer to give them an extra $5 an hour to get them up to that so you wouldn't have a wage reduction. Now, the other way to do that, which potentially would save you a little money, would be that you have these safe harbor dates. So as long as you eliminate the reduction before you file your loan application, then you don't have to apply the wage rate reduction. So in that case, if you get them back to their original $20 an hour wage in the pay period immediately preceding your loan application, in theory, that would eliminate the need to do the wage reduction test. So there are some planning opportunities around tipped employees that are out there that I would encourage business owners to take advantage of in the restaurant space if you're not able to have servers and other tipped folks come back at comparable wages. So I'm going to turn to the non-payroll costs, and I'm going to address some utility questions that we get. We get a lot of questions about what transportation utilities are, and unfortunately, I've got to tell you, we don't know what those are yet. We still have no guidance out there. We get people wondering if we have fuel costs for a fleet, can we include those? We really don't know if those are includable at this point. However, we do have some guidance out there on utilities for things like cell phones, internet, electricity. Those things that are specifically mentioned in the CARES Act. So, electricity is clearly mentioned, water, gas are clearly mentioned, telephone is clearly mentioned. Now, cell phones are not specifically mentioned, but we believe that if the company provides the cell phones to their employees and the company has the contract with the cell provider, that it is likely that cell phones would be considered a utility. And also, we do know that any internet-related costs are includable as a utility. Now, we get questions a lot about, well, what about, if I use a third-party hosting service? Are those hosting services or, a cloud-based system includable? We do not believe that that component is considered a utility, only the connectivity via the internet, but not the service component of a co-location or a remote hosting agreement, for instance. So we've got just a couple minutes left here, and I do want to make sure we get into the mechanics of the forgiveness calculations should you not be able to take advantage of the EZ form. And so, we always start with the amount that you paid for covered costs. And given the 24-week period now, one would think that you would always have at least your loan amount spent, and you could actually exceed the loan amount now on costs that are eligible for forgiveness. I mentioned now there's a couple additional tests that you have to apply to that. So in this first column here, first you start with what your eligible costs are for forgiveness. And then if you did have any of those wage reductions, that example I gave you earlier where you cut somebody's comp by more than 25%, you would reduce the allowable cost by that amount. And then last, but certainly not least, if you're not able to take advantage of one of the FTE safe harbors, you could get a reduction related to FTEs. Now, we firmly believe that this FTE reduction test, though, is likely not going to come into play for very many groups. Now, if it does come into play because you've terminated some folks, but it wasn't because of the COVID restrictions, given that you might be able to spend more than your loan amount during the 24-week period, it's not the end of the world that you might have an FTE reduction because you could still get to 100% forgiveness. And let me give you a quick example of that. So let's say your loan amount was $100,000. And during the 8-week period, you were only able to spend $80,000 on eligible costs. However, during the 24-week period, even though you might have laid off some more people, you might have been able to spend, let's say, $200,000 on eligible costs. Well, if you had an FTE retention ratio of only 50% in that scenario, because you're applying that 50% retention rate or a 50% attrition rate to a $200,000 number, you would still get to $100,000 of forgiveness in that scenario. So you don't think that because you don't have 100% on your FTEs that you are going to necessarily get less than 100% forgiveness. We know that there's a planning opportunity around that. So those three numbers give you one of the three potential loan forgiveness amounts. The second loan forgiveness amount is obviously the loan amount itself. You can never get more forgiveness than that. And then lastly, I mentioned that whole 60-40 test. You take the number of payroll costs that you incurred, divide that by 0.6, and that gives you your third factor. And what you do is you choose the lower of these three factors. And what we expect in a lot of cases is that the lowest of those three numbers is going to be your loan amount, and therefore 100% of your loan will be eligible for forgiveness. Now, the only other thing I want to mention, and I'll wrap up, is if you did receive an EIDL advance, this will impact your forgiveness. Now, not if you got an EIDL loan, but under the EIDL program, the Emergency Injury Disaster Loan Program, there was a $10,000 grant. And if you did receive that or some portion of that, which was based on $1,000 per employee, that amount will ultimately reduce your forgiveness. And so it is possible that, whatever forgiveness you're entitled to, whatever EIDL grant you received, that will be what ultimately is the non-forgivable portion of your PPP loan. So that was a lot of information. I know that I want to thank Patrick and Paul and others for answering questions in the chat. Hopefully we got to a lot of the questions that came in, and we did try to cover some of those in the presentation. The presentation itself, I believe, will be available through the bank, so please reach out to your banking contacts. The resources that we rely on within CLA are listed here too. I thought I would give you those. The Treasury website gets updated, it seems like almost daily, with new guidance, and so would encourage you to go there. Obviously, CLA keeps our website updated, and we do live streams that largely are focused on the Paycheck Protection Program. Those are done at noon on Pacific time on Tuesdays and Thursdays currently, and we would encourage you to attend some of those. So with that, I'll turn it back to Dan so he can wrap up our program.
Hey, Jack. Well, I hope everybody found this afternoon's presentation informative. I know I did. I have no doubt there will be more changes and more clarity about the rules and guidelines coming, so stay tuned. Know that we will do our best to assist you through the forgiveness application process. If you'd like to follow up on any questions or procedures, please reach out either to myself, your Banner Bank banker, or one of the CLA experts listed on that last slide here. Thank you again for attending today's webinar, and thank you again to CLA. Have a great afternoon.
Thanks so much, Dan.